Welcome to episode 13 of our Fundamental Analysis season. Today, we are tackling one of the most critical yet frequently misunderstood aspects of equity research, sector analysis. Specifically, we are going to explore why comparing giants like Nvidia to Intel is a fundamental error, and more importantly, how you can build the right peer group to ensure your valuation work is actually accurate. If you want to stop making rookie mistakes when analyzing stocks, this is the episode for you. Let's start with a cautionary tale. Imagine two analysts trying to value a semiconductor stock. The first analyst builds a peer group of 10 chip companies, tossing both Nvidia and Intel into the same bucket. The second analyst, however, is much more selective, building a custom peer group consisting only of fabless GPU designers. Their final fair value estimates end up diverging by more than 40%. This episode will show you why the second analyst is correct, and how the first analyst just committed a $2 trillion sector-level error that retail investors unfortunately repeat every single day. Why does this matter for your portfolio? Think back to the valuation ratios we covered in episode 11, like price to earnings, enterprise value to EBITDA, or price to book. These tools only provide value if you're comparing apples to apples. Use the wrong peer group, and a cheap stock will look expensive, or a dangerous stock will look like a bargain. Sector analysis acts as the essential filter between your financial statement data and your final valuation output. Without it, even the most perfect discounted cash flow spreadsheets you learned in episode 12 will just produce garbage. This skill is your primary defense against the most common error in fundamental analysis. To perform this analysis, we use the Global Industry Classification Standard, or GICS, which is the taxonomy powering the S&P 500 and MSCI indices. GICS uses a four-level hierarchy, 11 sectors at the top, followed by 25 industry groups, 74 industries, and finally, 163 sub-industries. Interestingly, both Nvidia and Intel carry the same 8-digit GICS code, ending in 45301020, which represents the semiconductors sub-industry. While GICS is a helpful starting point, as we will see, this lowest level is often still far too broad for the precise comparisons needed for accurate valuation. To see why that GICS code is misleading, let's look at a snapshot of these two companies for fiscal year 2025. Nvidia reported revenue of $130.5 billion, with a net margin of 55.9% and a gross margin near 75%. In contrast, Intel reported $52.9 billion in revenue, a net margin of negative 0.5%, and a gross margin near 35%. Even more telling, Nvidia's return on equity was 91.9%, while Intel's was negative 0.2%. These aren't just minor differences in degree. These are fundamental differences in the very nature of their businesses. If we look at their revenue DNA, we see where the money actually comes from. Nvidia's revenue is heavily concentrated, with $115 billion from data centers, representing 88% of their total, plus $11.4 billion from gaming, $1.5 billion from professional visualization, and $1.2 billion from automotive. Intel's revenue is much more fragmented, splitting $32.2 billion across its client computing group, $17.8 billion in foundry services, $16.9 billion in data center and AI, and $6.1 billion in network and edge. One is a data center GPU monopoly. The other is a diversified CPU maker trying to pivot into a contract manufacturer. The business model chasm between these two is massive. Nvidia operates a fabless model, meaning it designs chips but outsources the actual manufacturing to Taiwan Semiconductor. Consequently, their capital expenditure is low, with an asset turnover of 1.17 and a fixed asset turnover of 16.2. Intel operates as an integrated device manufacturer, or IDM, meaning it designs and manufactures its own chips and is currently investing heavily to manufacture for others. This results in an asset turnover of 0.25 and a fixed asset turnover of 0.5. These opposite capital intensity profiles mean that metrics like enterprise value to EBITDA or return on invested capital are virtually incomparable without significant, heavy adjustments. This brings us to rule number 1. Compare business models, not just tickers. Similarity in business models must always trump a shared sector label. A fabless chip designer and an integrated manufacturer face vastly different capital requirements, margin structures, and cyclical exposures, even if GICS groups them together. When you are building your own peer group, ask yourself, do these companies actually make money the same way? Do they share the same suppliers, the same customers, and the same cost structure? If the answer is no on any of these dimensions, you should think twice before including them in your analysis. Rule number 2 is that life cycle stage matters. You shouldn't put a mature company with flat revenue in the same peer group as a growth company that is doubling every 2 years. In 2025, Nvidia grew its revenue 69% year over year, while Intel's revenue remained roughly flat. If you directly compared their price-to-earnings ratios, 39.9 for Nvidia versus -658 for Intel, you would end up with complete nonsense. Mature peers for Intel might include AMD's client business or legacy hardware makers, while growth peers for Nvidia would include AI infrastructure plays. Mismatching life cycle stages is the second most frequent error in building peer groups. Rule number 3 involves geographic and regulatory exposure. Two companies in the same sub-industry can face radically different risk profiles. Intel derives significant revenue from China and is currently building foundries in Arizona and Ohio under the CHIPS Act. Meanwhile, Nvidia's H100 and H200 chips became subject to U.S. export controls to China starting in 2023, forcing them to design compliance-grade chips. One company faces geopolitical supply chain risk, while the other faces geopolitical demand risk. These distinct exposures fundamentally affect earnings quality and the discount rates you should apply, making direct comparison hazardous without explicit risk adjustment. Now, let's discuss sector-specific metrics. While the universal valuation ratios from episode 11 are great, every sector has specialized KPIs that capture value drivers those generic ratios simply miss. Using a price-to-earnings ratio for a bank ignores regulatory capital requirements. Using enterprise value to EBITDA for a software-as-a-service company ignores the quality of recurring revenue. Similarly, using revenue multiples for an oil company ignores reserve depletion. For the rest of this episode, we will look at the professional metrics used for 6 major U.S. equity sectors, starting with the area where the most retail money is invested. In the telecom sector, analysts use enterprise value to EBITDA and enterprise value per subscriber. U.S. wireless carriers trade on EBITDA multiples because they have vastly different capital structures. For instance, AT&T has a 3.3 times net debt to EBITDA ratio, while T-Mobile sits at 3.8 times. EBITDA is useful here because it normalizes for leverage and strips out the massive depreciation charges from decades of network investment. Typically, U.S. wireless carriers trade at 7 to 10 times enterprise value to EBITDA, while European carriers trade at 5 to 7 times. For subscriber valuation, U.S. wireless subscribers are worth $3,000 to $5,000 each, whereas European subscribers are valued at $1,500 to $3,000. For banks, enterprise value is useless because debt is not separable from operations. Deposits are simultaneously liabilities and the raw material of the business. Instead, we use equity multiples like price to earnings, price to book, and price to tangible book. The most critical regulatory metric here is Common Equity Tier 1, or CET1, which measures core equity capital against risk-weighted assets. JP Morgan Chase and Bank of America might have similar price-to-earnings ratios, but if they have different CET1 ratios, they have different capacities to return capital through buybacks and dividends. If a bank is trading below 1 times tangible book, it might be cheap, or it might simply be undercapitalized. In the retail sector, we focus on sales per square foot, which is total revenue divided by selling floor area. Apple stores are the gold standard, generating more than $5,000 per square foot annually. By comparison, the average mall retailer generates $400 to $800. Costco generates roughly $1,300, and Walmart is closer to $450. Online sales make this trickier, as a customer who browses in-store but buys online still utilizes the physical asset. To cut through the noise, analysts use comparable store sales growth, which measures year-over-year revenue from stores open at least 12 months, revealing the true demand for the business. Software and SaaS companies are valued on annual recurring revenue, or ARR, multiples rather than earnings because they reinvest so heavily in growth. The median public SaaS multiple entered 2026 at 6 to 7 times enterprise value to revenue. However, the real differentiator is net dollar retention, or NDR, which is the percentage of recurring revenue retained and expanded from existing customers. Companies with NDR below 100% typically trade at 1.2 times revenue. Those between 100 and 110% command 6 times, while those above 120% can see multiples jump to 8 times or higher. A 10-point improvement in retention can boost a valuation by 20 to 30%. For oil and gas, you cannot use standard discounted cash flow terminal values because the core asset, proved reserves, physically depletes. The industry standard is net asset value, or NAV. This is the present value of all future cash flows from proved reserves, discounted at 10%, which we call PV10, minus net debt, divided by shares outstanding. Analysts also track enterprise value per barrel of oil equivalent, finding and development costs per barrel, and the reserve life index, which is total reserves divided by annual production. A company with low finding costs and a high reserve life index is efficiently replacing what it pumps, a critical efficiency that no price-to-earnings ratio can capture. Finally, for real estate investment trusts, or REITs, we ignore net income because it is artificially depressed by depreciation on assets that may actually be appreciating. We use funds from operations, or FFO, which is net income plus depreciation and amortization, minus gains on property sales. A more conservative version is adjusted funds from operations, or FOO, which further subtracts maintenance capital expenditure and leasing commissions. REITs trade on price to FFO multiples and dividend yields. Crucially, equity REITs like Prologis and American Tower are valued very differently from mortgage REITs like Annaly Capital. So mixing them in one peer group is a common mistake for beginner investors. To tie this all together, look at Tesla. While Tesla and Ford both make cars, their business models are worlds apart. Tesla generates revenue from vehicle sales, energy storage, solar, and software subscriptions like full self-driving, with gross margins ranging from 18 to 25%. Ford generates most of its revenue from internal combustion trucks and SUVs, with an EV segment that lost roughly $1.3 billion per quarter in 2024, and a company-wide gross margin near 10%. Tesla trades on technology and growth multiples, while Ford trades on value and dividend yield. A proper Tesla peer group would include BYD, Rivian, Lucid, and Sunrun, not legacy automakers. How do you build a peer group for any company? Use this 3-filter test. Filter 1 is the GICS sub-industry. Start with the narrowest classification available. Filter 2 is the business model match. Check the revenue breakdown in the latest 10K, and if primary segments differ by more than 20 percentage points, exclude that candidate. Filter 3 is the financial profile match. Compare gross margin, capital intensity, and revenue growth. If a candidate deviates by more than 50% from the median on 2 of those 3 metrics, exclude it. What remains is a tight, high-quality peer group where your valuation ratios will finally provide meaningful, actionable insights. Be aware of a major red flag. Companies change their business models, which can invalidate your peer group. Intel's push into foundry services transforms it from a product-only company into a hybrid product plus service firm. If foundry revenue hits 30% of the total, Intel's peers should shift toward TSMC and global foundries rather than AMD and Nvidia. Similarly, Amazon's acquisition of Whole Foods forced analysts to split the company into AWS and retail, each requiring different peers. Always re-verify your peer groups annually when the new 10K is released. A static peer group is a recipe for outdated, inaccurate analysis. To synthesize our lesson today, remember these 4 principles. First, GICS is a map, not a verdict. The lowest level is still too broad. Second, business model similarity matters more than product similarity. Third, every sector has its own unique vocabulary of value, whether that is FFO for REITs or NDR for SaaS. Fourth, Peer groups are living structures that must be re-verified every year because companies constantly pivot, acquire, or divest. Master these 4 rules, and the valuation work you learned in the previous episodes will become significantly more accurate and reliable. Coming up next is episode 14, where we discuss economic moats. Now that you know how to group companies into proper peers, the next question is, which company within that group is actually built to last? We will cover the 5 Morningstar moat types, wide, narrow, and none, using US examples like Apple, Coca-Cola, and Visa. We will learn how to identify the durable competitive advantages that separate temporary winners from long-term market leaders. I look forward to seeing you in the next episode.